Okay, so welcome to Are You Ready for a Financial Crash? And a little bit about me and what I do. So my name is Karen Newton. I'm the founder of Karen Newton International. I have worked in the finance industry for around 45 years, starting first as a clerk in Inland Revenue in the UK. I spent 4.5 years working on self-employed. And then I moved to New Zealand where I joined a young bank. And as a result of that, I worked in a lot of different departments. As the bank was growing, I was able to be promoted and go into different sectors of the bank. So I have done visa, lending. I was a specialist lender for $500,000 or more projects, and we're talking back in the 1980s, so that was big sums of money. I worked on the Forex exchange. I was in the data processing department, and I worked in the accounting, as well as being in a branch and then working my way up to manager in a branch. So I have quite a wide banking background. And then I've had my own businesses since the 1990s. So I do have a wide range of skill set and information, I'd like to call it. So what I do is I'm an investor, and I have a property portfolio, which is a global portfolio. I'm in markets which are global markets. Precious metals, and there's lots of precious metals, and I will talk a bit more about these. I moved into crypto, and I've gone mainly into DeFi, which is decentralized finance. And I retired back in 2003, wealthy enough to not have to work again. But it was boring, and so I set about writing books. I have now written 22 books. And those books are published in 15 countries and have gone to #1 in 6 of those countries. So what I'm going to do today is I'm going to look at what's happened in history, what is repeating in history, and where I see the warning signs for what is coming up now. So first of all, I'm going back to the 1918-1921 pandemic. Now, this pandemic started when soldiers were returning from the First World War. They had a virus, and that spread right around the world. Now, it was called the Spanish flu, but it didn't originate in Spain. It was named the Spanish flu because Spain was the country that identified the specific strain. But the key point that we want to look at here in the 1918-1921 pandemic is what is called the forgotten recession. And as soon as countries went into lockdown, there was a recession. And what that recession did was it triggered people coming into, when I say it triggered the government to increase spending, and that led on to catastrophic situation. And you'll see the similarities between what is happening at the moment. So when the pandemic ended, we went into the roaring 20s. And this was a real boom time, with the governments encouraging people to spend. And they spent. They were into property, creating a property bubble. They went into the share markets, creating a share market bubble. And the newspapers were full of buy, buy, buy. The governments wanted this feel-good factor, and it lasted for a few years, and then came the big crash. And that crash led to the Great Depression. So in the Great Depression, people just totally lost their jobs. And while this happened in America, and you would have, if you've gone back to the old photos or anything, you'll see that people just couldn't get jobs. There were no jobs for them. But despite it being in America, it actually spread globally. In Australia, they had soup kitchens where they were feeding kids. In UK, again, they were food kitchens. But in Germany, it was slightly different because Germany went into hyperinflation. And if you can see this image, these are carts of money that people were using to go and buy their food. And a loaf of bread would cost 4.2 million drachma. So this recession ran from 1929 to 1946. Most people feel that the Second World War brought people out of the depression. However, it was something different, and I'm going to go through that now. So really, what were the triggers for the depression? Well, first, there was this feel-good factor after the pandemic. People wanted to get out, they wanted to spend, they wanted their freedom, they wanted to travel and do all the things that they used to be able to do but had been restricted from doing. The Fed, which is equivalent to central banks in other countries, kept increasing the money supply into the economy. And the money supply went up 61.8%. Governments encouraged spending. They wanted people to go out and spend as much as possible. And this created a property market bubble. It created a stock market bubble. And what happened was the Fed got a bit concerned and decided that it was going to cut the money supply in the economy. And it did it really drastically. It suddenly cut money supply by 1/3. And suddenly people didn't have overdrafts. Their overdrafts were gone. They had banks calling in their loans, and the money just was not there for people to continue spending. The property market bubble burst, and that took down not only the property, but all the support businesses that go with the property market, and it took down the share market as well. And this led to businesses closing and unemployment skyrocketing. So how did they end the depression? Well, first I'm going to show you this chart, which is from 1929 to 1939. And this is the US. This is where the depression came in, and you can see unemployment was very low. It was around about 3%. It actually shot up to just under 25%. And what the government did was it started trying to bring in all these different incentives. Things like building the Hoover Dam was one of the projects to try and bring unemployment down. Some of these projects did start to bring unemployment down, but then it started to go back up again because the projects weren't big enough for the amount of population that had no work. And then we got to 1939 and the start of the war. And what the war did was it changed the focus of people. So it meant that patriotism came in. Everybody switched to defense of their country, building factories and doing everything that they could. The men went off to war, the women ran the factories and did all the work to try and keep the men supplied at war. Now, after the war, there were initiatives in many countries when the soldiers were returning, and the initiatives were to give them land. And the hope was that they would farm it create orchards, grow food, because there had been so much food shortages during the war. And this was one of the steps that helped to start putting normality back into the economy, with the return of food and supplies going in there. And the government continued spending on infrastructure projects. So these were some of the triggers to try and bring an end to the Depression, but the key one was what's known as the Bretton Woods Agreement in 1946. So what was the Bretton Woods Agreement? Well, it was where 44 nations came together and they agreed a way to stabilize economies and to stabilize the currencies. And the way they did this was that they agreed that a specific currency would be worth $1 US. So, for example, in France, they probably said like 4 francs would be worth a US dollar. Okay, and each country had its own ratio to the US. What the US did was it agreed to hold gold reserves for every dollar in circulation. So we had an economy that was asset backed. So every dollar that was written, there was gold reserve for it. But then in 1971, US President Nixon took the US off the gold standard and effectively cancelled the Bretton Woods Agreement. And what that did was it made currencies become IOUs. So IOUs, something if you hand me a dollar. It made the economies debt-based rather than asset-based. And these debt-based economies are what have grown to create the problems that we have today. And just as a side note here, when the Bretton Woods Agreement was cancelled, when it was cancelled, when Nixon took the US off there, Forex trading was established. And that's grown into a massive industry today. But should the countries go back to a Bretton Woods style agreement, it is likely that Forex trading will cease because we won't have this movement between currencies. So history repeats. Today we have a pandemic. Many countries went into lockdown in March 2020 and have many restrictions on them today. We have again what's called the forgotten recession. Remember, I mentioned that in the 1918-21 recession. In March, most countries, after they locked down, it triggered a recession. And many countries have actually basically brushed that aside, tried to forget all about it, but it had a massive impact on current economies. Quantitative easing, there's been pumping of money into the economy, and that's been done in many ways, such as the furlough schemes, out and out just printing money. And then we've had this feel-good factor, encouraging spending, to the extent that I know in the UK, they were giving people vouchers if they would go and eat in specific restaurants. Everything was geared up for, we're back to normal, go spending, we want you out there, forgetting about the problems, we want this feel-good factor. The US has continued with quantitative easing. Just last week, it got approval to print $1.6 trillion to put that into the economy. Now, it has been pumping money into the economy since last year, and it's trillions every month. But once it got the approval for the 1.6 trillion, it then turned around and said, we need another 3.5 trillion. So that is now going through Congress at the moment. The UK, well, they spent round about 660 billion on incentives, furloughs, propping all sorts of things up to try and keep an economy moving. And the EU did a record loan out to, well, record borrowing as a package so that they could then put money out into different European countries to help support them. I know the package that came here to Spain was 75 billion. And when you think there's 27 countries in the EU and they all put in claims, you can imagine how big the package was that the EU put together and borrowed. We have the problem where businesses are closing. Many businesses are closing down around the globe. Many did not reopen when some of the lockdowns were eased. We have a property bubble. Now, the government's encouraged people to buy property. That has triggered a property bubble. It's triggered all the support businesses to grow as well. And that property bubble is really on the cusp of bursting at the moment. The share market is in a bubble as well, and that is growing to an enormous amount around the world. Again, it's on the cusp of a burst. So economies are currently balanced on a knife edge towards hyperinflation or deflation. So what is deflation and how does that affect us? So first of all, a deflation means the cost of goods go down. So everybody's there saying absolutely fantastic, goods are cheaper. That's brilliant for us, but it's not so good for the businesses, because what happens is consumers postpone their buying because they're waiting for cheaper goods to come. And so, for example, if you were going to buy a car and you knew that prices were going down, you would probably wait until next year because you think that the price of the car is going to be cheaper. And that happens with all sorts of industries. And that results in businesses have less revenue, so start cutting wages and laying people off. And that then means that there's less money in circulation. People who have got loans, mortgages and other debt, it takes up a greater percent of their income to meet those debts. So they in turn have less money to spend, and that then goes round in a cycle, which means the cost of goods has to go down even more. This is an image for Japan. Now, Japan went into deflation in 1995, and you've got the zero line here. So anything in red is where they've been in deflation, and anything in what looks like a mustardy color means they had inflation. And as you can see, it has become extremely difficult for them to get back to inflation. And most countries need inflation. On the other hand, we have hyperinflation. And recently, Zimbabwe is a good example of hyperinflation, because this is a copy of a note that they had, which is a promise to pay the bearer $100 trillion. And this dollar note was in 2008. So you can imagine having a $100 trillion note. And unfortunately, that note did not buy you very much at all. Hyperinflation is when there's lots of money in circulation, too much money, and what happens is you have an item for sale, but there is so much money chasing that item that the person who's selling just keeps putting the price up and up and up and thinks, right, I might as well take my profit. One of the problems with that is the price going up all the time, which makes it unsustainable for people to buy. And consumers start hoarding essentials because of the increases. They know that their wages are worthless, so they hoard whatever they can to protect themselves from the price increase. So, coming up to the current situation, where are we today? Well, we do have high inflation. For example, here in Spain, electricity rose 36% in June. Petrol and diesel went up 26% between April and August. The cost of food is up. Officially in the UK, it's up 4.8%. I can tell you I've done my grocery shopping this week and the cost of food here has gone up round about 20%. Property prices in the UK in the month of June were up 13% in 1 month, and in Ireland they were up 15% in the month. And the cost of raw materials for manufacturing, the official figure is they were up 7% in July. And that means that with all these increases in everything, the cost of getting the product out to the market means we aren't going to see a 7% increase. We are going to see much higher increases. Now, governments actually want some inflation. It is much easier for them to control than deflation. Now, how they control it is by increasing interest rates. Now, I was around in the 1980s. I was living in New Zealand. There was high inflation and my mortgage rate was at 21%. In the UK, it was at 15%. So how the governments use interest rates is when the economy is going upwards and when they've got inflation, they try to increase the rate so it stays a couple of percent above what the inflation rate is. And this then helps to take money out of circulation and helps to bring some of those prices down. Another way they use it is to literally take money out of circulation. So they will say to the banks, you collect the money as it's coming in, we want so much of this paid back to us, and we're just totally reducing the amount of money in circulation. Another way that they control inflation is by putting up taxes, because again, that reduces the amount of money that people have to spend. And finally, they will give low pay increases or no pay increases. And in the UK in particular, we've already seen Bank of England indicate that interest rates are likely to go up. We've already had the indication that there's going to be higher taxes. And if you've seen the pay rises of the government, the police got no pay rise at all. So the government is starting to look and starting to warn that it's going to take money out of circulation. Governments like a 2% inflation rate. It means it's controllable. People are quite happy with their spending. We don't have this high inflation where it becomes very expensive to buy things. It just means that the country plods along quite nicely. So if the government can get inflation to 2% or slightly under, they're happy. So what are the markets doing today? Well, first of all, France and Germany have asked for a return to the gold standard. They have been trying to do this since the credit crunch of 2008. And there's a lot of momentum behind this at the moment. And many countries are starting to come on board and see it as a way of stabilizing currencies again and getting back to more stabilization in the markets. In 2020, the IMF issued a report suggesting that cryptocurrency be used as the base in lieu of gold. And they wanted to use their own cryptocurrency that they have in circulation out there at the moment. However, their 2021 report backtracked on crypto, saying that crypto is the scourge of the world. It's what's behind terrorism, drugs, gun running, all sorts of crime. And so it did a total backtrack on using crypto as a base for a currency standard. And they suggested that we go to a Bretton Woods II agreement, which is sort of suggesting that we could be looking at some sort of gold standard again. Now, Basel III agreement is an agreement that was negotiated about 4 years ago, and it was as a result of the mess that the banks were in following the credit crunch. It came into effect in Europe 1st of July, and what they did was they assessed that gold had a 0 risk rate. So they are encouraging banks to have their own gold reserves. And many banks have now pumped a lot of their money into gold. And it's one of the reasons we saw gold go up so much in the past year. And it was all preparation for this Basel III agreement coming in. Now, the problem with the Basel III agreement is it's likely to have an effect on the ETF markets. And the ETF market is the electronic traded fund markets. Now, at the moment, you can buy paper gold, and these paper transactions are supposed to be backed with gold. But if the banks are holding and grabbing as much gold as they can, it means there's a lot less gold in circulation. So as more and more ETFs are issued, it means that it's unlikely to have the full amount of gold reserves that's needed to match the ETFs. COMEX, which is the biggest gold market, doesn't have any gold reserves. So it's quite interesting that with the COMEX, when you trade on there, you have to settle in cash. And by settling in cash, they don't hold any gold at all. If you want to be paid in gold, you have to give the COMEX 3 months notification in writing that you would like to be paid in gold when the contracts you have come to an end. Banks in the US have reduced or stopped lending. There's Wells Fargo actually went to the point of asking clients to repay loans, and other banks have totally reduced the amount of lending that they're currently issuing. Credit unions in the UK are asking clients to withdraw funds. They don't want large deposits because it costs them to have that money deposited. So they are now asking clients to remove their cash. And many banks worldwide are faced with negative interest rates. And what that means is if they're holding money on deposit, all banks have amount of money that's in circulation. The way it works is they let the central banks know how much they've got, and the central banks are actually charging them interest on having that money in the bank. So that's why it's called negative interest rates. So what can you do? Business. First of all, we look at side hustles. Now, side hustles are those business ideas that are a little different to what you do in a normal business. And as an extreme example, if we said we had a real estate agent who's obviously out there selling property and he had a side hustle of selling computers, you can see that it's different. But side hustles can be very profitable. Cottage industries. What happens when we have a recession or a depression is that big businesses implode. And with those businesses closing down, people go back to their cottage industries and they start building businesses again from small. And that's what I call cottage industries. It can be any very small business, little startup businesses. Network marketing is a phenomenal growth. It's been going since 1970, and whenever there's a recession, it has phenomenal growth, because as people are laid off, they're looking at how can I make money and what is cheap for me to get into. And network marketing is a cheap industry to get into. And food supplies. Now, there is already warnings of food shortages. I know if you have a look at the UK, they already are suffering food shortages. Northern Ireland's got food shortages. So anything that where you can grow some supplies, support yourself and sell to someone else, then that will be a good business model for the future. Property. Don't buy property at the moment. Right? The property market is at a high. It's in a bubble. It's getting ready to burst. And what we actually want is to buy low, sell high. If you're buying now, you're buying in at a high and you're setting yourself up to lose money. So don't buy property at the moment. Loan to value repossessions. Now, they are pretty common when there is a recession. What happens is loan to value is where banks say a property is worth 100,000, the bank will give you a mortgage of 85,000, so you have an 85% loan to value. When the property prices start coming down, the banks still insist on that 85% loan to value. So that means that you can be asked to repay lump sums of money to keep your mortgage coming down. Most people don't have that kind of money to pay, and so the bank steps in and repossesses the properties. A lot of this happened in 2008 to the extent where landlords lost property. You also had homeowners who were forced out of their properties, and eventually the government, after this big bust up, if you like, in the newspapers about it, eventually the bank stepped up, Parliament stepped in and said there's to be no more repossessions. But those terms are still in a lot of people's mortgages. So when the property bubble does burst, it's likely that we will see loan to value repossessions. So it's one of the reasons I say don't buy property at the moment. And if you're thinking of remortgaging, don't remortgage either. If you want to be involved in property, then lease options is the way to go. Right, so with lease options, there are different types of options out there. You can get control of a property. If the property bubble bursts, you can always hand the property back under a lease option. You're not tied into that property. Rent to buy options, these are seller finance. So as long as there are no mortgages on a rent to buy, and it's literally the seller providing the finance, rent to buy a really good way to start getting your hands on some property without having mortgages. Digital investing. So digital investing is your paper, is your shares, cryptocurrency, you've got your bonds, gilts. There's a whole range of investments that come under digital. So we do have a share market bubble, but we use strategies to maximize returns. And for people who are part of the US investment club, you'll know that we use things such as calls and puts where we are getting returns on the shares. So it's the investment club is a very good strategy for a recession because we have different ways of earning money. Also, we invest for dividends, and the more money that we can get into dividends, the better. And dividends can be dividends of shares, but you can also invest your cryptocurrency and get dividends back on that, which you can use as cash. And that's where your cryptocurrency comes in as a digital investment at the moment. Bullion, gold is going to be one of the best that you can invest in when there is a recession. Silver is the other precious metal to get into. Silver tends to follow gold and it outperforms gold 3 to 1. I don't know why 3 to 1, but if you go through history, if gold goes up, silver goes up 3 times more. If gold goes down, silver drops 3 times faster. So it always moves 3 to 1. So silver is a very, very good investment to get into at the moment. As I look today, the gold silver ratio is at 78. That means it takes 78 coins of silver to buy 1 gold coin, which means silver is really, really undervalued at the moment. And then we have other precious metals such as platinum, palladium. They're going to be used with the electric cars. Lot of potential for those to go up. And copper is an industrial metal, so that when economies start to move and manufacturing starts to grow, then copper tends to go up. And my advice is go global. Don't keep everything in one country because countries will react differently. They are already reacting differently. And if you are in one country and that country's decisions go against you, you lose everything. If you're in several countries, then you have the chance of protecting some of the assets that you have. So we have multiple streams of income and we have 8 different types of income. And the more income streams that you can build now, the better you will get through a recession. Okay, so these are the 8 different types of income streams that you can generate. And most of the wealthy, the rich, have at least 5 or 6 of these income streams. So as I said, the more that you can build of these, the better it will be for you. If you struggled when the COVID pandemic started and when the country went into lockdown, and if you found yourself struggling then you will struggle in a depression. So the more types of income streams that you can generate, the better it will be for you. So timeline. What is happening at the moment is America has made the announcement it is going to let inflation continue. It wants higher inflation. So one, it's been printing so much money, trillions and trillions of dollars, so that if it has inflation, that in effect reduces the amount of money they have to repay. The UK have already indicated an increase in interest rates, so they are going to be trying to control inflation. The EU traditionally sits back and waits to see what everybody else is doing and then comes in later. Banks are already withdrawing lending, and banks are starting to hoard bullion. The indications are there's going to be a tightening of funds in circulation by the end of 2021, and we are looking at a 2022 recession. And the big question is it going to be a recession or a depression? And the answer is, at the moment, we don't know, but it is looking more like it could go into a depression. So you need to take charge of your finances now. So the Zero to Millionaire course teaches you how to create multiple income streams, how to create side hustles, how to do dividend share investing, gold, silver investing, using property options, cryptocurrency investing, joint venture opportunities, investment clubs, and it's now fully automated, because I know there's many people who have not been able to get onto training courses. They can't get to the meetings that we're holding, and so I have now created a fully automated system, and that is at €49.97 per month. The benefits are you learn how to generate wealth, you have a pathway to creating multiple income streams, training to suit all levels of skills and knowledge, free events with guest speakers, joint venture opportunities, investment clubs. And this is a testimonial from Tony Thomas, who is a Financial Times top 10 IFA for 3 years on the trot. And he said, Karen's a great coach on how to build wealth through a club. Karen shows you a number of different strategies, starting with very little money, on how to build income and capital in a friendly, supportive way. I have no hesitation in recommending Karen and her club if you want to learn how to build wealth. So sign up now. If you scan this QR code, then it will take you straight through to the Zero to Million course, where you will be able to sign up and start learning how to make money so that you can thrive in a recession or a depression.